In 1602, a group of Dutch merchants created something that had never existed before. Not a kingdom, not an army, not even a traditional trading company. They created the first modern corporation, and with it, they accidentally invented the economic system that now runs the entire world. Most people think capitalism emerged gradually, evolving naturally from markets and trade. But that's not how it happened. Modern capitalism didn't evolve, it was engineered. In a single moment, by a handful of businessmen in Amsterdam who were trying to solve a very specific problem. They called it the Verenigd Oost-Indisch Company, the Dutch East India Company, the VOC. And what they built was more than a company. It was a template, a blueprint for how to concentrate power, transfer risk, and extract wealth on a scale the world had never seen. They didn't just trade spices. They created shareholder capitalism, stock markets, limited liability, corporate governance, and financial instruments that wouldn't be fully understood for another 300 years. Welcome to the Finance History, where we explore the moments that shape the way money moves, power accumulates, and history gets written by those who control the ledger. To understand why the VOC matters, you need to understand the problem it was designed to solve. In the late 1500s, European powers were obsessed with Asian trade. Spices, silk, porcelain. These weren't luxuries, they were strategic resources. Spices preserved food. They masked the taste of spoiled meat. They were medicine, currency, and status symbols all at once. But getting to Asia was brutally expensive and incredibly dangerous. Ships took years to make the round trip. Storms destroyed entire fleets. Pirates were everywhere. And even if you made it there and back, you might return to find prices had collapsed because 3 other expeditions arrived first. The traditional model was simple. Rich merchants pooled money for a single voyage. If the ship returned, profits were distributed and the partnership dissolved. If it sank, everyone lost everything. Each voyage was its own separate gamble. This system was chaotic, inefficient, and insanely risky. Merchants competed against each other, driving up prices in Asia and driving down prices in Europe. Nobody could plan long-term. Nobody could build infrastructure. Nobody could sustain losses without going bankrupt. The Dutch looked at this mess and asked a different question. What if we didn't dissolve the company after each voyage? What if we made it permanent? That single idea changed everything. In March 1602, the Dutch government granted the VOC a 21-year monopoly on all Dutch trade east of the Cape of Good Hope. But here's what made it revolutionary. Instead of funding individual voyages, the VOC raised a permanent pool of capital. Investors bought shares, not in a single ship or voyage, but in the company itself. This meant several things that had never been true before. First, the company could think long-term. It could build forts, establish outposts, negotiate treaties, and wage wars. Things impossible when you dissolve after each voyage. Second, investors could sell their shares to other people without disrupting operations. You didn't have to wait years for your ship to return. You could cash out whenever you wanted by finding someone else to buy your stake. Third, and this is crucial, investors had limited liability. If the company failed, you only lost what you invested. Your personal assets were safe. This one innovation unlocked investment from people who would never have risked everything on a single ship. The VOC didn't invent joint stock companies. Those existed. But it was the first to combine permanent capital, tradable shares, and limited liability into a single structure. And that combination created something unprecedented. An entity that could outlive its founders, accumulate power across generations, and operate with a logic entirely separate from any individual's interest. Within years, the VOC became something the world had never seen. A corporation that functioned like a state. It raised its own armies. At its peak, the VOC had more soldiers than many European nations. It negotiated treaties as if it were a sovereign power. It established colonies, built cities, and governed millions of people who had no say in Amsterdam shareholder meetings. The VOC could declare war, mint currency, and execute prisoners. It was, in every practical sense, an empire. But unlike traditional empires, its only mandate was profit. It had no ideology to defend, no religious mission, no duty to its subjects. Just shareholders expecting returns. And here's where it gets interesting. This created a completely new form of power. Kings ruled through divine right and military conquest. The VOC ruled through contracts, equity stakes, and supply chain dominance. Kings extracted wealth through taxation. The VOC extracted it through monopoly control and price manipulation. Traditional empires conquered territory to tax the people living there. The VOC conquered territory to control what moved through it. They didn't care about ruling Indonesia. They cared about ensuring nobody else could access Indonesian spices without going through them. Sound familiar? It should. The VOC pioneered strategies that modern corporations still use today. Take vertical integration. The VOC didn't just buy spices. It controlled production, transportation, warehousing, and distribution. From the plantation to the European market, everything moved through VOC infrastructure. This meant they could manipulate supply at every stage to maximize prices. Or consider market manipulation. The VOC famously burned warehouses full of spices to create artificial scarcity. They destroyed nutmeg trees to limit supply. They enforced contracts that prevented locals from selling to anyone else. This wasn't capitalism as we're taught it. Free markets, competition, innovation. This was monopoly capitalism, using force and financial engineering to eliminate competition entirely. And then there's risk transfer. This might be the VOC's most lasting innovation. Shareholders provided capital and took on financial risk. But operational risk, the danger of storms, pirates, disease, war, that was transferred to sailors, soldiers, and colonized populations. Workers were paid fixed wages regardless of profit. Local populations bore the cost of violent enforcement and resource extraction. Shareholders, meanwhile, collected dividends from thousands of miles away, insulated from consequences. This wasn't accidental. It was the entire point. The VOC structure was designed to concentrate gains and diffuse losses. For nearly 200 years, the VOC printed money. At its peak, it was the most valuable company in history, worth roughly $7.9 trillion in today's terms. For context, that's more than Apple, Microsoft, and Google combined. It paid consistent dividends for decades. Share prices rose steadily. A secondary market emerged where people traded VOC shares daily. The Amsterdam Stock Exchange became the first modern stock market, and VOC shares were its primary product. But here's what nobody talks about. The VOC success wasn't built on efficiency or innovation. It was built on violence and monopoly power backed by state authority. The VOC conquered the Banda Islands and committed genocide to control nutmeg production. They enslaved populations across Indonesia. They manipulated local rulers, funded coups, and waged wars purely to maintain market dominance. And the shareholders in Amsterdam, they knew. They voted on military budgets. They read reports detailing atrocities. And they kept collecting dividends because the system was designed to separate profit from accountability. This is the blueprint that survived. The idea that a corporation exists solely to maximize shareholder value, that violence in pursuit of profit is just security costs, that those who provide capital deserve the gains while those who provide labor or resources bear the risks. All of this traces back to the VOC. The VOC eventually collapsed in 1799, buried under debt and corruption. But the structure survived. British, French, and other European powers copied the model. The British East India Company essentially ruled India using the same playbook. American corporations inherited the same legal frameworks. And today, nearly every major company operates as a descendant of the VOC structure. Think about it. Limited liability still exists. Shareholders still aren't personally responsible for corporate actions. Companies still operate across borders with more power than many governments. Supply chains are still controlled by those who own the infrastructure, not those who do the work. And the same pattern repeats. Gains flow to capital. Risks flow to labor and communities. Those closest to the choke points extract value. Everyone else negotiates from weakness. Modern corporations don't use the VOC's language, but they use its logic. Tech platforms don't own content, but they control access to audiences, just like the VOC didn't own spices but controlled who could sell them. Financial firms don't produce wealth, but they sit at the intersection of capital flows, exactly where the VOC positioned itself on trade routes. Amazon doesn't manufacture most products it sells, but it controls the infrastructure connecting producers to consumers. It can see every transaction, set terms for every participant, and extract fees at every stage. The VOC would recognize this immediately. And when companies fail today, who pays? Workers lose jobs. Communities lose tax revenue. Pension funds lose value. But executives often walk away with golden parachutes, and major shareholders diversify their risk across multiple companies. The VOC taught us how to engineer this outcome. Here's the uncomfortable truth. We don't live in a system that emerged naturally from human cooperation and free exchange. We live in a system designed in 1602 by Dutch merchants who wanted to extract maximum profit from Asian trade while minimizing their personal risk. Every time we hear fiduciary duty to shareholders, that's VOC logic. Every time a corporation prioritizes quarterly earnings over long-term sustainability, that's VOC thinking. Every time gains are privatized while losses are socialized, we're watching the VOC playbook in action. And just like the VOC shareholders who never saw the plantations, the violence, or the exploitation, just the dividend payments, most of us interact with modern corporations the same way. We see products, services, and share prices. We don't see the supply chains, the externalized costs, or the power structures that make it all possible. So what's the lesson? It's not that corporations are evil or that capitalism is doomed. It's that the system we have isn't natural or inevitable. It's designed. And if it was designed once, it can be redesigned. The VOC proved that you can build enormous power by positioning yourself between producers and consumers, by transferring risk away from capital, and by using legal structures to separate profit from accountability. But here's what history also shows. Every system eventually fails when the gap between power and accountability becomes too large. The VOC collapsed when its corruption and inefficiency exceeded even its monopoly advantages. Other empires fell the same way. The question isn't whether our current system will change. It's whether we'll redesign it deliberately or wait for it to collapse under its own contradictions. If you want to understand where power really lies, don't look at who's working hardest. Look at who controls access. Look at who captures value without producing it. Look at who profits when things go right and escapes consequences when things go wrong. The VOC figured this out 420 years ago. And once you see the pattern, you can't unsee it. If this changed how you think about modern economics, subscribe. History doesn't repeat, but its patterns echo loud enough to hear, if you know where to listen.